So one way of trading options that you can do is doing what we call selling options, selling premium. I'm sure that you've heard about, people selling options, and I'm definitely one of them. I sell mostly options. I think I've never really bought options as a strategy. I think I've always sold options, and this is a strategy overall that I think is very profitable. However, and it's very important to understand the risk of, a strategy, because there's always risk, first of all, and especially when you sell options, there's this type of phenomenon that can cause you to lose money that you really need to understand before you start selling options. Because the thing is, it's very, very easy to be, blindsided by the gains that you're making and not really see the risk that you're taking when you're using a new strategy. And I know it because I've been there, so I know how it feels. But it's so important to understand what are the risks that you have when you sell options. And especially here in this video, we're going to cover something that is really, really important to understand. And that's what I call the biggest risk when you sell options. But before we dive into the video, if at any point you have any questions, just don't hesitate to put a comment below. I'll be happy to answer any question that you might have. And if you find this video interesting or helpful, don't hesitate to like it and subscribe to my channel. That's really the best support you can give me. And that also lets me know after that in my analytics which type of videos you like to watch. So first of all, we're going to talk about what is selling premium, what is selling options for those who might not know what it is. Then I'll go on into explaining what is really the risk that you have when you are selling options. Then I'll show you examples of that risk that actually happened to me like 3 days ago when we had the SPY moving down. It was quite a big down day, and I had that phenomenon happening on 2 of my positions. So I wanted to show you some examples so you can see visually what does that risk mean, and not only in theories, because obviously with examples I feel we always learn more. So but first of all, let's cover what does that mean selling options as a way to trade. So when you are trading options, you could do exactly the same as when you trade the stock directly. So for example, when you trade the stock, let's say you trade Tesla, you could buy the Tesla stock and you could also short Tesla stock. I'm sure that you're familiar with the terminology going long or going short. Meaning if you go long, you bet that the stock price is going to go higher, and when you go short, you bet that the stock price is going to go lower. Well, that's exactly the same with options. You can go long on certain options, or you can go short on certain options. And there's going to be obviously differences, because when you go short an option, you want the option to decrease in price, so you can buy it back at a lower price. For example, if you have an option that is costing $3, well, if you short it, then you're hoping that that option is going to lose value. Well, that's what we mean by selling options, and very often that will be referred as selling premium, because the price of an option is what we call the premium. So we usually refer to selling premium as for selling options. It's just a terminology thing. It doesn't imply anything. That's just to let you know that selling options is often called selling premium. And there are some big differences between buying options and selling options. For example, if you sell options, there'll be first of all a very big difference in terms of time decay. So for those who wouldn't know, every day that passes, options lose a tiny bit of value, and the closer they are to expiration, the bigger the amount that they're losing on a daily basis. And that amount that they're losing on a daily basis, we call that the time decay. And the reason for that is that every day that passes, there is a decay that is happening. So knowing that every day that passes, options lose a tiny bit of value, if you buy option, you're going to have that time decay working against you. But when you sell options, you're going to have that time decay working in your favor. And the reason why is that if you decide to short an option, let's say we take the same example, you have an option that is costing $3. But if you have that time decay that is happening, let's say that every day that passes, the option lose 10 cents. So the next day, the option will be now worth $2.90. The next day, $2.80. And that's a very, very simple example, but the principle is there. Because we want the option to lose value, then the time decay is exactly doing this for us. It's exactly making the option lose value. So it's great. So when you sell option, the first difference is that the time decay is going to work in your favor. Then there'll be another difference, and that is basically the main subject of that video, and that will be the biggest risk after that, and you will understand that. But let me explain what is the second difference between buying an option and selling options. As I said, there is another difference between buying and selling options, and that is the implied volatility. So what does that mean, the implied volatility? Well, the implied volatility is basically the expected move of a stock. And to make it very simple, basically when there is a lot of hype around a stock, or a lot of people are willing to buy, for example, certain options, then the price of that option is going to increase. And that's that implied volatility. You're going to have that phenomenon of volatility that is going to modify option prices. And to make you fully understand, when you have a lot of volatility, the option prices are going to increase, and the implied volatility is basically a reflection of option prices. If the option prices are getting more expensive, then the implied volatility will go higher, and vice versa. If the option prices are getting cheaper, then the implied volatility will go lower. And so you have this phenomenon where you have also that volatility that is going to come into play. And the difference between buying and selling options in terms of implied volatility is that if you have less and less volatility on the options, then those same options are going to become cheaper and cheaper, which if you sell options is great for you, because if you have less and less volatility, then options are getting cheaper and cheaper, and as you shorted the option, then that's great for you. You're winning money, you're earning money. But if you had bought option and the implied volatility is decreasing, then technically you're losing money, because ideally if you buy options, you want to buy options when the implied volatility is rising, because that means that option prices are getting more and more expensive. So that's the second difference between selling and buying options. That's about the implied volatility. So now that we understand finally the two differences, the two main differences between buying and selling options, we're going to focus on the implied volatility. And let me explain why this can be the biggest risk when you sell options. You see, the thing with the implied volatility is that it's going to very often follow what the market does, meaning that when the market climbs up, usually you're going to see the implied volatility decreasing little by little as the market is going up. And usually when the market crashes, like very suddenly, or not necessarily crashes, but at least have a very strong down move, you're going to see the implied volatility rising like a lot and very, very quickly. Proof of option prices getting more expensive very suddenly. And the reason for that, we need to go back a bit in time so as to understand why this is happening. Usually when you have a crash that is happening, this goes very, very quickly. I mean, the stock market goes down a lot quicker than what it comes up. And what usually happens is that you have the implied volatility rising a lot quicker than what it falls. And the reason for that is that when the market crashes, a lot of people are going to buy, puts and calls, and there's going to be a lot of expectations around what is going to happen. So because the market are crashing a lot faster than what they're going up, we're going to see the implied volatility going higher a lot quicker than when it comes down. And let me show you in Tastyworks so you can see what I mean. So we are in the Tastyworks platform right now, and what you have in front of you is the chart for VIX, for the VIX. VIX. So if you're not familiar with the VIX, this represents the implied volatility for the S&P 500 index, meaning that you have the S&P 500, you have the implied volatility of the S&P 500, well, that's the VIX. For those who don't know, the VIX is usually referred to the fear index. And we call that the fear index because as the markets are usually going down a lot quicker than what they're going up, the VIX tends to spike very quickly during a crash, and then it comes down a lot more slowly over the next month. For example, you can see that the VIX went from 14 to 85 a lot quicker than what it went from, for example, 85 to 14. And I think we're not even back to 14 yet. I mean, you see that we went back to 14, I think, if I remember well, for the first time on June 30th, 2021, when actually it had topped 85 in March 2020. So you see that it took more than a year to come back to the levels that we were before the COVID crash happened. So as you can see, when the market crashes, then the implied volatility rises a lot quicker than what it falls when the market is climbing up. I hope it makes sense. That's a very, very weird sentence to say. But what does that mean? Why am I showing you all of this? Like, what is the point of that? Well, if you remember what I just said before, when you have the implied volatility that is rising, it means that option prices are getting more expensive. So when you have a crash, for example, that happens like, last year in 2020, and you have the VIX going from 14 to 85, well, that is a proof that option prices on the S&P 500 got super expensive and very quickly. We can see that in the span of like 10 days or 15 days, they must have at least tripled in value. I mean, at least. Looking at how the implied volatility rose, I mean, that made the options very expensive. But you would probably tell me, what is the problem with all of this? Well, if options are getting a lot more expensive when there is a crash and that goes super quickly, well, that is obviously going to hurt people that sell options, because as you short options, you want the price to decrease. And if you have a crash and you have that volatility that comes into options, making them a lot more expensive, then that is going to hurt option sellers. And usually what is going to really hurt option sellers, especially if they sell naked options, it is volatility expansions. Volatility expansions usually go hand in hand with a down move, because as I said, the implied volatility tends to rise when the market is going down, and the implied volatility tends to go down when the market is going up. So if you have the market going down quite quickly, you have this implied volatility rising, proof of options getting more and more expensive. Well, usually that's where the biggest risk lies when you're selling options. Usually you're going to experience some very quick, I'd say bigger drawdowns when you sell options, because usually when you have a volatility expansions, you're not only going to have your options going in the money, you're also going to have all that implied volatility going into the options, making them more expensive. And if you have sold those options, then you're going into a drawdown. And when you sell options, usually the max loss is going to be bigger than what you can win on the trade. That's quite normal actually when you sell options. So if you don't protect yourself, what is going to happen is that you're going to start selling, for example, let's say naked options. You're going to sell naked options, and the day where there is a crash, there's going to be, first of all, a huge move going against you if you have, for example, sold some put options, but you will mostly suffer from the volatility expansion. That down move will bring so much volatility into the options that you will lose money because of the option prices getting more and more expensive due to the volatility. So that's what is the biggest risk when you sell options, because obviously, when you have one thing going wrong, you usually have everything going wrong. It's not only one thing. You're going to have your option going in the money, you're going to have volatility expansion, you're going to go into a big drawdown where usually 95% of the time you are fine when you sell options. And that's usually the very big trick when you sell options, that 95% of the time, or let's say 90% of the time, you're going to be fine. You're going to be fine, you're going to win your trades, like it's going to be really cool for you. But that 5% of the time, you're going to suffer a lot, because that's where really, genius fails. He fails when he doesn't understand the risk that there can be when you sell options. But obviously it's always better when you have visual explanations and you have like some visuals on this theoretical stuff and what we call volatility expansion. So let me go into Tastyworks and let me show you some trades that went against me when we had that volatility expansion several days ago. So right now what you have in front of you is the chart for the stock FCX. You can see that the stock up there is FCX. So what happened is that I had sold a put credit spread on FCX, and I think I had literally sold like at the highest point. I thought that the stock was going to come back, and I think that I had sold like the 38 put. I need to check that, but we're going to see after. And basically what happened is that several days ago, like 4 or 5 days ago, 3 days ago, I don't remember, the SPY went down. And if we look at the SPY chart, we can see that was on that day. And that was quite a big down move compared to actually what we usually see. Usually we don't have like, such a fast down moves. Usually, it goes down quicker than when it comes up, but that down move was, let's say, quite moderately big. And what happens just with that down move was actually quite impressive. I saw the options that I had sold, for example, on FCX and on Under Armour. That's another losing trade that I'm going to show you. I've seen those options just like skyrocketing in value, making me go into a loss. And that's what this volatility expansion is. The SPY going down and especially gapping at the beginning of the trading session on the 19th of July, well, that created like a lot more volatility in the market. And if we look at the VIX, you can see that the VIX went from 16 to at the highest 25. So obviously it's not at all the same thing as, when we had the COVID crash. Obviously it's not at all of the same type, but just that down move, reminds us enough that when you sell options, the biggest risk that you can have is when you have that down move in a volatility expansion, because regardless of what you do, you're going to have options getting more expensive expensive, just, regardless of what is happening in the market, you're going to have the option getting more expensive because of that volatility that is brought back in the market. And for example, I had some trades. So here we are in my position stamp, and I had 2 trades actually that went against me at that point. It was a trade on Under Armour and a trade on FCX, as I said. So unfortunately, I'm not in a drawdown anymore, so I cannot show you. I should have maybe shot a video on the day where I had the drawdown. But basically the question is, when you have this type of things, what can you do to try to get yourself out of this situation? Well, the way I manage losing trades is quite simple in a way, but this is actually very effective. I'm usually going to roll my trades. And what does that mean, rolling your trade? Well, I'm going to close my current position. I'm going to take my loss, and I'm going to open a new position in a later expiration, and hopefully I will do all of that transaction for a credit. And that's called rolling your trade. And by rolling your trade, you're extending the duration of your trade. Basically, you're saying that yes, you were wrong on that, for example, expiration, but that you bet that the trade will come back in your favor in the next expiration. So that implies that you still believe in the trade coming back in your favor. So when that volatility expansion happened, what I did is that as the volatility went up, options got more expensive on FCX and Under Armour. Options got a lot more expensive actually, and I was quite in a big drawdown. What I did is that I took advantage of that volatility expansion. Instead of, just going through a drawdown and hopefully the trade comes back in your favor, you can roll your trade when, you have that volatility expansion happening. So the new options that you sell in the next expiration, you have all of that volatility within the premium, and you're taking advantage of all that volatility expansion. And personally, that's the best way I found to deal with this type of losses, is that instead of just either taking my loss and moving on, or just leaving my trade as it is, I might as well close it and sell a new option in the next expiration that has all of that volatility built in. For example, let me show you what I mean. Right now we are in my transaction statement, so that's where you can see where I basically do all my trades and stuff. If we look at what happened, I, for example, sold that put credit spread on FCX on the 12th of July. So as you can see, I collected in total 93 cents of credit, as you can see up there. Then after that, what happened is that on the 19th of July, so that was the day where the stock went down, and because the SPY went down, you had all of that volatility expansion, and I was in a loss, I think, of several $100s. I mean, it's not bad, but obviously if you can act on it, and if you can roll your trade sooner than later, it's probably better. So what I did is that I closed my position in the August expiration. So as you can see, I bought back my short leg and I sold back my long leg, because I always do put credit spreads so as to protect me, by the way, during crashes. And I sold a new put credit spread in the September expiration. So as you can see, I sold a new put credit spread. So in total, I was in a loss of around $200, I think, when I sold my new put credit spread on FCX. But if you look at what happened now on FCX, so after the day went down, as you can see, it started going back up directly. So this is all happening in the span of 4 or 5 days. You can see that the stock went down for 4 days straight and even gapped at the end. And then after that, directly after I rolled my position, after I opened my new credit spread in the next expiration, in the September expiration, the trade started coming back in my favor. And as the trade is coming back in my favor and the stock is coming back up, you have the implied volatility going down again. And I'm sure that we can actually put the IV rank so you can maybe see that. Okay, so I've put the IV rank on the chart at the same time so you can also see the implied volatility moving as the stock is going up and as the stock is going down. So what happens is that as the stock goes up, you can see that the IV rank comes up. And then as the stock is coming back up, you see that you have the IV rank going down, proof of the implied volatility going down, and proof of option prices getting cheaper. So on top of rolling your trade, having the trade coming back in your favor, meaning that options are going more and more out of the money, you're also earning money because of that implied volatility going down. So you have that double effect where, yes, you had a bit of a drawdown before, but as you rolled into strength, as you rolled your position when the implied volatility was high, then you benefited from that high implied volatility, and as the stock is going back up, that is going down, options are getting cheaper, and you're earning even more money. And if we look at, for example, my positions tab, well, you can see that my position on FCX, so as I said, I think I was in a loss of around $200 in total when I rolled my position, And well, now I'm $125 profit on that position, so I'm around $80 short of the break-even point that I had. So meaning that when that position will reach $185 or something around this, well, that's where I'll be at break-even basically, and I'll have recouped all of the loss that I had in my previous trade. So that's how you can basically take advantage of the implied volatility going up. So it's not necessarily a bad thing when you have, for example, a drawdown, when you have a volatility expansion. That's the biggest risk, because if you just sell naked option, that will usually cost you a lot of money on the long term. Because when you don't have a lot of volatility in the markets, you are going to have to sell options that are going to be a lot closer to the stock price. And what happens when you have a volatility expansion? All of those options are getting more expensive, and as you had sold an option very close to the stock price, then now you're in a very big drawdown. Hence why I prefer to sell credit spreads when we are in a low IV environment, so I don't basically get caught up into this type of bad down moves. And honestly, it's been working well to sell credit spreads in low IV environments and sell naked options in high IV environments, because at least when you are in a high IV environment, you are like full on taking advantage of that high implied volatility. And you know, I feel that when you're in a low IV environment, when nothing is happening, that's usually where it's the riskiest to trade. And a big volatility expansion is truly the worst thing that can happen to you if you sell options, and on top of that, if you sell naked options, because then you don't have any protection, you don't have that long leg that is going to act as an insurance like I would have, for example, when selling credit spreads. So I hope that makes sense. I hope that maybe showed you what was really the biggest risk when you sell options, and that's unfortunately something that is, in my opinion, not known enough usually when you sell options, because when you have that big volatility expansion, that is going to make options a lot more expensive, and if you sell options, you are going to lose money because of that. And usually you have a volatility expansion because you have a down move. So if you have sold puts, well, you're going to be in an even bigger drawdown. You're going to have like double negative effect. So to sum up, to protect yourself from a volatility expansion, you can sell credit spreads. You can sell credit spreads, and that long leg that you will sell will act as an insurance in case of a crash. For example, right now I have some trades that are going against me. And if we look at, for example, apps, APPS, Digital Turbine, I have sold a call credit spread on apps, but what happened is that the trade is going against me. As you can see, I have sold a short leg, and that short leg is at $134 loss. But I have the long leg that I have bought, which makes the credit spread, that is in a profit of $44. And that's really the nice thing about credit spread, is that if you find yourself, let's say, in a very bad crash or something happens and you have sold a credit spread, well, you're not going to lose as much money as someone who will have sold a naked option in a low IV environment. You're going to be protected, and you're going to have a max loss, which is really nice. And I already hear it, how can you roll credit spreads? Because usually that's very hard to roll credit spreads. Well, that's why personally I make them very wide. I make my credit spreads very wide. And for example, if I show you, you can see that I have my short leg at the 70 strike and I have my long leg at the 80 strike, meaning that what I'm basically betting here is that I'm betting that the stock is staying under the 70 level, meaning that if it goes in the money, I mean, I'm going to be protected thanks to that long leg. So I'm really buying the 5 delta usually. If I show you, for example, in the option chain, for example, right now, you see that I'm usually buying the long leg a lot further out the money, because I want to keep most of the premium that I'm selling in the short leg, and that makes your life easier when you're trying to roll the option after that. So to sum up, the biggest risk when you sell options is that you have that potential volatility expansion, and usually it goes hand in hand with a down move. So on top of having, a down move, and if you have sold puts, you're going to be in drawdown, you're going to also have that volatility that is going to go against you, and that is going to make you lose even more money. So that's why the best protection that you can do to yourself when you sell options is to sell credit spreads. That way you have a max loss, and you know that you can survive, like a down move, because you're going to be protected. You're going to have that long leg acting like an insurance. But if it still happens to you and you're in a drawdown, you can still roll your trades, as I showed you what I've done on FCX and Under Armour. You can roll your trades, and ideally, if you roll your trade when the stock is going down, you're going to sell another credit spread went with a much bigger premium, with a much more expensive option, and that's great for you because you're taking advantage of that volatility expansion instead of being hurt by it. So I hope that makes sense, and I hope that FCX example that I just showed you maybe makes you a bit more understand what is going on when you have a down move and how it works and how you can deal with that volatility expansion. As I said, if you have any questions, just don't hesitate to comment it below. I'll be happy to answer any question that you might have. Please make good and informed decisions. I'll see you in the next video, and in the meantime, I wish you all the best.